Welcome to Remarkable Retail Podcast, Season 6, Episode 19, presented by Market Dial. I'm Michael LeBlanc.
And I'm Steve Dennis.
We have a solo episode, as we would call it for the people. Today, Steve, what we still get wrong about physical retail.
Yes, we haven't done a solo episode that wasn't some kind of recap, I think, in a few months. Mm-hmm. One of the very nice things has been that it seems like most of the people we asked to come on as guests actually say yes. Our yield was better than usual.
That's true.
So that got us a little bit boxed out in terms of some non-guest episodes. But here we are talking about maybe some myths, misconceptions, and why they matter.
For the listeners looking ahead, we have more great insights and interviews coming up from our time in Barcelona, as they would say in Barcelona. And a very special guest coming up in a few weeks, someone whose work I've really admired and devoured, Jason Del Rey.
Yeah, Jason's got a book coming out about Amazon and Walmart and just kind of the evolution of retail. Haven't quite got our preview copy yet, but I suspect that will show up in the mail any day now. And I'm really, really looking forward to reading it and talking to him. He's got great perspective and has been, let's say, along for the ride in retail and digital transformation for quite some time.
Absolutely. All right, well, let's get to the news. Let's start at U.S. monthly sales up 2.9%. Is that month over month or year over year? Break that down for us, because we do seem to repeat year over year being more important. Is 2.9% real? What's going on?
That is the year over year number. I have to really resist my little hissy fit about how these numbers get reported. So I'm just going to move on from that. I'm going to let that go. Yes, that is the year over year number.
Deep breath.
And that is for the U.S. and that is across a spectrum of categories. So, of course, we see different results depending upon the category of merchandise. But I think the big headline here really is we continue to see deceleration in growth. And that apparently is a function of a continuing shift to essentials, the effect of inflation, interest rates, people spending on travel, big ticket sales being affected by home sales being slow, the pull forward, a lot of things we've talked about in the past. But I would say the overall picture. Which still, by the way, I mean, you just rattled off a bunch of things, but I just have to interject that often when I'm looking at analysis, they're forgotten. Like this is the first year in 4 years where people, at least in North America, can travel unencumbered. Yeah. And we bought a lot of stuff during COVID, and I think it bears repeating. So thank you for repeating it, because I think it gets, I'd say, glossed over when people go, and we'll be talking about it later, Home Depot sales are off year over year. Yeah, because they sold like 1 million patio heaters, and you only need so many patio heaters, right? Yeah. I mean, I think it's complicated, but clearly there are pressures on consumer spending in general. But yes, there are a lot of other factors that are determining the pace of spending, but definitely an overall slowing down. Now, when you look down kind of beneath the hood a little bit, really the only winner, I would say, as a category, and this is one that's been, I think, in this category for like a year, maybe more, is health and personal care. Again, the growth rate there is slowing a little bit, up about 6%. I think we had seen numbers like 8 or 9 most of last year. Then you've got the very mediocre numbers, general merchandise stores. So that's stores like Walmart and Target, Costco, et cetera, and only have about 4, which is probably less than inflation. And then I thought this was interesting. Grocery and beverage stores were only up 3%. I don't know if that's because, I assume some of that is people going out more or traveling more, and so they're not eating at home. But that's where we've seen the greatest amount of inflation. That definitely suggests traffic being down, items being down. Then we've got a bunch of losers, so to speak. Big L on the forehead. Laggards, yeah. Maybe that's a nicer way of saying it. Clothing stores continue to be weak, down about 4%. Home category, both the Home Depot kind of home, as you alluded to, down like 6%. Electronics and appliance stores down 8%. Furniture and home furnishings down close to 9%. Sporting goods, which had been a pretty strong category, down about 9%. So again, I think this is a lot of that pull forward spending we've talked about, but definitely a picture of consumers trading down, slowing down, and maybe
changing
spending on other
priorities.
things. Changing priorities.
Change of priorities. I mean, you and I talked about this over the years of the COVID era that, eventually when, fortunately, this thing kind of simmers down, that people's focus will shift to more experiences than things.
Right.
So I think we're seeing that. So I just wanted to reiterate that if I haven't done that already half a dozen times in this episode. We're kind of in a big earnings cycle. So let's talk about some of the big news out of a couple of the biggest retailers this week. Let's start with Walmart.
Yeah, we are definitely getting into the cycle here. I think we've got department stores and some others that'll be reporting next week. But yeah, we got the two biggest retailers in the U.S., Walmart and Target. Walmart was stronger, not amazing, but quite solid. Their sales were up about 7%, and whereas Target was pretty much flat. I think the thing with Walmart, if you want to just kind of compare and contrast with Target, is Walmart is, as many people probably know, the biggest grocery store in North America. Their strength was very much in grocery and essentially more essential items.
Essentially more essential,
great. Essentially more essential items. They highlighted weakness in more discretionary type of spending. Target said essentially the same thing, but Target does not have nearly the essential grocery balance of sale that Walmart does. They've got more discretionary type items. So Walmart was clearly the winner in the battle between the big two, and both of them gave a pretty tepid outlook for the near future in any event.
All right, so that's Walmart and Target. Now I mentioned them already. Let's talk about Home Depot.
Yeah, this was a pretty weak report from Home Depot. Again, this kind of continuing weakness in all things home. They had their first comparable store sales drop in several years, I think. I forget the exact number of quarters, but their sales were down over 4%, and their earnings took a bit of a hit as well. They basically guided that they expect their comp store sales to be down 2 to 5% for fiscal year. So between Target and Home Depot, you've got two retailers, huge retailers they're guiding to lower sales. We also got a couple of apparel players, TJX, the off-price retailer, and Ross Stores. Both were pretty mediocre. TJX overall had sales up only 3%. It doesn't seem like, generally speaking, customers are in much mood to buy clothing pretty much across the board. On a positive side, they did have their gross margin improve. Folks may remember that many retailers were sitting on a ton of inventory.
Yeah.
And TJX was moving through that the last couple of quarters. So it looks like that's stabilized a little bit. The other quick thing with TJX is some folks may know they own this chain called Home Goods. And that was really the laggard in their portfolio. Yes, HomeSense and Home Goods. Their comps were down 7%. So again, not a lot of spending on soft or hard home products. Then Foot Locker, which I think we talked about a couple months ago about this new strategy that they've announced. Well, it's definitely not taking hold yet, though it's quite early.
Early days.
Yeah, very early days. But their comparable store sales were down 9%. So apparently nobody wants to buy footwear except for an exception that we'll talk about in a moment. And their net income went down. They did have their inventory go up year over year by 25%. So, sales down 9%, inventory up 25%. I would say kids start looking for some markdowns this summer.
Yeah. What would you call it? They're kind of being delevered, right? I mean, their sales are down. They probably brought in inventory to match prior sales. And so they got some running to do, some catching up to do. All right. Well, let's talk about a sturdy unicorn. So here is a story, and it's actually a good one to talk to right after Foot Locker. Let's talk about On Running, which is really I didn't know that much about On Running. You brought them to my attention, and the more I look at them, the more I'm impressed.
Well, it is literally a remarkable story, and as regular listeners will know, we often point out the wobbly unicorns, these brands that were started in the last 10 to 15 years, generally vertically integrated, generally raised a lot of money to grow, but have had a hard time making money. Well, On Running has no such problems, at least so far. They had a blowout quarter. Their sales were up 80%, and they're already $1 billion plus business. So that
I
is
was going
not
to say,
trivial.
how big are the, that's, it's one thing if you're a small business with those kind of comps, but $1 billion, that's real money. That's
and they are in a number of countries. So this is a fairly diverse business at this point. Still, comparably small, but gross margin up. They've had growth in both wholesale and direct to consumer. Their net income tripled. Their market cap is now over $8 billion. So they are almost a deca unicorn, I guess one could say. And what I think is kind of interesting, I don't know that they really consider themselves a digitally native vertical brand, because they really followed kind of a classic fashion or apparel brand strategy of very much being in wholesale channels as a way to grow and build awareness, in addition to supplementing with direct-to-consumer. And I think you can contrast that, at least until fairly recently, to a number of these digitally native brands, which really didn't want to have a store presence, generally stayed away from wholesale because they thought that somehow it was going to be more profitable being able to kind of control the whole thing. But what On has done, I think very much like Yeti, another brand that's grown quite quickly by balancing wholesale with direct to consumer. And so that seems to be a very, very successful strategy. If we want to contrast this with a brand we talked about a couple of weeks ago, Allbirds, started around the same time. Allbirds went very much direct to consumer, not wholesale until fairly recently. And now On has become really kind of the hot shoe among entrepreneurs as well as serious runners. They are in quite a tear.
All right. Well, let's you and I wear them on the stage at the lead and be hip with the crowd.
Might take a little bit more for me, but baby steps.
Get just a little closer. All right. Well, that's a quick look at the news. Now, just before we dive into our What We Still Get Wrong About Physical Retail episode, let's hear from our presenting sponsor. If you're a retailer hungry for a better way to gain useful insight on the impacts of your store layout, design, and strategic initiatives, you need to know Marketile. Marketile is an easy-to-use testing platform that emboldens great decisions, leading to reliable, scalable results. With Marketile, you can be confident in the outcome of your in-store pilot initiatives before rolling them out across your fleet. Validate your remarkable ideas with Marketile's in-store testing solution. The proof is in the testing. Learn more at Marketile.com. That's Marketile.com. All right, well, let's get to our main event, so to speak. What we, the royal we, still get wrong about physical retail. My first question is, people have been doing physical retail for a long, long time. Why are we still talking about this?
Well, I think my overall motivation for this is I still believe, and I'll talk about some examples as we get further into it, there are a lot of myths or misconceptions or false narratives or just weird ways that people think about physical retail that may lead them in the wrong direction, cause them to make some strategic mistakes. So my hope is we can kind of clear that up a little bit and talk about why some of these misconceptions actually matter. It is a bit of a companion piece to something that we did way back now in November of 2021, where we talked about what we get wrong about e-commerce. So same kind of approach, just anchored more on brick and mortar.
Yeah, and it's a bit more, what should I call nuanced? Because, you and I, we aligned very early on when we met around the whole media canard around the retail apocalypse. But we go a lot deeper with a lot more, subtlety or a lot more different things that are going in different ways. Question for you, question that we asked ourselves before we came up with this episode is why now? Like, is there any urgency? And I think you made a pretty compelling case.
Well, I think there's two kinds of urgency. One is, and there was an article actually in the Wall Street Journal that kind of spoke to this, is that with this growing economic pressure, and we talk about it as, the tide is going out, it's going to reveal some weaknesses that were perhaps masked either by extraordinarily low interest rates, stimulus payments, consumers just in general spending tons of money on all those things. Yeah. For the most part, those kinds of dynamics are going away, in addition to some of the things we talked about at the top of the show in terms of inflation and higher interest rates, et cetera, et cetera. So I think the economic pressure is going to reveal more fragility on the part of many retailers. I also think that, and this is just a question of the sooner the better, I guess, that you start. But to the extent that retailers, like we can just talk about Bed Bath & Beyond, let's say, clearly they needed to make a lot more changes much more quickly. So if you're a retailer that is experiencing some of the struggles that folks like Bed Bath & Beyond have experienced in recent years, well, you may need to get much more aggressive, both in terms of the degree of change, but the pace of change around your transformational efforts, because you're getting more headwinds than tailwinds at this point.
Yeah, well put. All right, so let's get into the details. Well, I already mentioned it a little earlier on. We should probably start for, I guess, context at the retail apocalypse canard. Speak about that. Just very quickly, because I think at this point most people realize that there really never was a retail apocalypse, or it was very focused into some particular areas. Here in the U.S. anyway, sales through physical stores have been positive for 14 straight years. Thousands of stores continue to be open. Last year, we actually had more stores open than closed for the first time in a while. So, I think we just kind of have to get that out of our head. It only really matters to the extent you still basically believe this, and therefore your conclusion is, I shouldn't invest in physical retail. Now, that may be the case if you have a weak value proposition, but even when we were speaking, and I guess one of the things I glossed over in talking about Walmart sales was that Walmart had their e-commerce increase about 27%. We've been seeing a lot of retailers that are reporting decreases, but a lot of that is really around having invested in e-commerce for sure, but really investing in things like online pickup in store and ship from store. So we've seen Target and Walmart and lots of others who decided to invest in their stores as kind of the hub of omnichannel fulfillment. So if you believe that everything was moving online, you would not have invested in your stores. You would not have seen them as assets, and you would have really missed a ton of business opportunity. Now, the more contemporary myth, I should say, or the way that people are phrasing it, is the retail is back. If you believe there's an apocalypse, I guess you believe that retail is back. But now we're into a different phase of being backness, I suppose you could say, all the way back, circling back to the beginning of the episode. How are you thinking about the state of retail and the trends that we're in today?
I think both at the World Retail Congress, where we were together, as well as at Shop Talk Europe and Shop Talk in Las Vegas a few months ago, I heard people say physical retail is back a lot. And so I wondered, that sort of feels true, I guess. And certainly physical retail is back relative to the depths of COVID. So if we go back to when stores were closed or people were not trafficking stores, that's true. But is retail traffic and sales higher in the last year or two? And broadly speaking, the answer is no. If you look at traffic across a spectrum of categories, and I went in and looked at some of the our friends at Placer AI data, for the most part, traffic in most categories is flat or down. In some cases, it's down quite a lot, particularly apparel stores, and which, really kind of lines up with the numbers we went through at the top of the episode. The truth is, yes, there are some retail formats that are gaining traffic, but broadly speaking, physical retail is relatively flat in terms of sales growth. Down in traffic, people are tending to concentrate their sales in fewer stores. So, and I would say generally, we've got obviously the near-term headwinds that are likely to keep traffic quite muted for, who knows, 6 months, 12 months. But I think the overall picture generally is that traffic to physical retail is not coming back as a broad statement. So why does that matter? Well, if you're feeling sanguine because somehow everybody's back to shopping in stores and you think that's going to be the thing that's going to drive you forward, well, maybe be a little bit more careful because, again, while that's true in some instances, broadly speaking, traffic is down, and that means you've got to do a much better job of differentiating yourself to try to win traffic back if that's a possibility, or you've got to do a much better job converting the traffic that you were able to get and, try to drive up average ticket and net promoter scores and all those kinds of things.
I love that point because, I remember in the pre-COVID days when we were thinking about traffic being down that retailers, and our advice, I know my advice to retailers was turn your minds to getting more people in the store to buy more things versus trying to get more people into the store. And, it's money well spent. It's like not unlike e-commerce, right? Don't worry about driving traffic to the homepage. Get people checking out. Now, right. Is there room in your thinking for the COVID bump, like the comp store issue? In other words, here in Canada, a lot of stores were very locked down. We had Omicron, which we almost forget about it, but it was like just over a year ago. And there was a big rush back to the stores in the spring and summer because there was some pent up demand. Are we seeing a bit of that? It's a short term thing. I don't think it changes your narrative, but is there room in your thinking for that?
Yeah, I mean, I think just like people are eager to go back out traveling, I think we're seeing some people just, wanting to get back into certain kinds of stores because they haven't been doing it or haven't been doing it as frequently. So I think there's a little bit of that. But I think, every week, every month that goes by, there's less of that kind of revenge spending kind of thing, as well as just, what we talked about earlier, that there's just not as much spending power that people have. The other thing too is, inflation has obviously lots of negative consequences, but it can also make your sales numbers look better, right? If there's 7% inflation based into your number, you look like you're running an increase, but in fact, you're not necessarily really gaining share or performing well. But I think the big picture issue, which, some people may think fights a little bit against what I said with the retail apocalypse, but it is still the case, particularly in the US, I think a little bit more in Canada and the UK, there is still overall a huge mismatch between the supply of real estate and the demand.
I was going to ask you about that. I was going to say, is that still the case? Because that certainly was a big part of the narrative that became the retail apocalypse narrative, that there was just we saw pictures of, the Walking Dead malls kind of thing, right?
Yeah, there's definitely been some rationalization of that. So the excess is not quite as pronounced as it was going into COVID. So it's reconciled or kind of reset a bit. But it's really a question, and this is, what I've said a million times, that the apocalyptic part is really about the collapse of the unremarkable middle. It's the poorly positioned real estate or the poorly positioned retailers. They're the ones that have a problem. And when dollars are getting spread out over all sorts of retailers, and then just in general, if the economy continues to be weak, you just have more real estate that's going to, be underwater essentially.
Yeah. So what did you describe it as one time? Kind of a showroom for Caterpillar bulldozers or something? I think you said.
Well, yeah. You might want to, if you're thinking about buying Macy's stock, you might want to buy bulldozer stock because there's clearly lots of space chasing too little demand, and what it will take in some cases is the amount of money it would take to reconfigure that real estate to a higher and better use is
doesn't make sense.
Pretty tough numbers. And it's in fact been made worse because now interest rates are 5% roughly higher. So, the interest rate thing and the tepid demand broadly, from a macroeconomic perspective, maybe that's only a year phenomenon. But I think the longer term trend is that if you were one of these retailers that's stuck in the middle, a la Bed Bath & Beyond, a la, lots of other, Kohl's, et cetera, your life is not getting any easier. And I would argue in many cases it's about to get much tougher.
Let's talk about talking about confusion, or I don't know how to describe it, but this intersection between physical retail and e-commerce. And I still get questions about, I'm worried about cannibalization as if it's a zero-sum game, but it really isn't. Expand on that for us.
Well, I'm still surprised. I mean, I've been saying, silos belong on farms and embrace the blur and all these kinds of things for 10 plus years. So this is not a new idea. But yes, there still are I was just with a retailer in the last couple weeks. There still are retailers that really measure physical store performance and online performance very independently. The reality is, in most cases, consumers are active in both channels, if we want to use the channel terminology, that physical drives e-commerce drives, or digital drives physical, so there's a lot of interplay between the different channels. And if you tend to measure your store performance and your online performance in isolation, then you're very likely, and I've lived through a bunch of this, both companies I work for as well as companies I've consulted to, you may actually make some pretty dumb decisions. You might misallocate your marketing spending. So, for example, if you have your e-commerce channel responsible for all digital advertising, they will, and focused on their online sales, they will underinvest in online advertising because they're not getting credit, so to speak, for physical sales. Similarly, you might close a physical store if you just measure its four-wall profitability, and then discover, as many retailers have, that when you close the store, your online business actually goes down because customers are using it for showrooming or it's marketing or, online, buy online, pick up in store. Thinking about physical versus e-commerce as a zero-sum game, I guess you focus really on the wrong thing, which is kind of this intramural warfare, as opposed to how are you going to grow share of wallet, how are you going to grow total trade area performance, regardless of where the customer happens to ultimately transact. Plus, the other thing, which I know you've heard me say many times, is we have to remember that when we hear these numbers about e-commerce growth or e-commerce sales, that is typically where the product is ordered. Yeah. It's not necessarily how it's fulfilled. And so, again, you could say, well, gee, I'm going to keep growing e-commerce. I'm not going to spend any money on stores, but you won't get that sale if the customer wanted to go pick it up, or or you're using that store as a fulfillment point for e-commerce orders or returns and those kinds of things. So you really have to look at it all together. And again, I'm still shocked that there are pretty sophisticated companies that aren't doing this.
I have an anecdote for you to kind of bolster that. I was, it's Mother's Day last week, and I knew what I wanted to get my mom, but of course I didn't get around to it. But there I am, Sunday morning, and I'm looking for a very particular kind of shoe. And lo and behold, of course, I go on their website, and they offer in-store pickup. And I'm like, wonderful. And I check for the shoe, and it's in stock, in a mall very close to me. I'm like, beautiful, order it online. And then I get the confirmation email, your shoe will be ready in 4 to 6 days for pickup.
Yeah.
Okay. So I just go anyway, right? I mean, I'm like, come on, I just go anyway, because they said on the store locator that it was in stock. So it was pretty clear to me, at least, that it was being picked from shelf as opposed to being shipped there, which I would understand. So I get to the store, and I'm like, hey, I ordered this thing. I didn't get a confirmation email, but I'm sure you have it. And there's nobody in the store. Like, there's 2 associates. One, like, they're very nice. But they were like, hey, how are you doing? And I'm like, and they're like, well, we haven't picked it yet. I'm like, okay, it's right there. Could you pick it for me? And they, they're like, okay, yeah, we could do that. But then the more interesting thing is, I started talking to the store manager, and she says, I love the fact that you have to buy this because I can't give you the one you ordered. And you just have to ignore that one and let it lapse. But the good news is I get the credit for this one.
Yeah,
I don't get the credit for the one you ordered online, picked off myself. And it's literally the same pair of shoes in the same box. And I'm like, why the hell would you disincentivize? It's baffling. I don't know.
It's crazy. And I like I said, I think we've talked about this for so long. So
right. It's not like e-commerce is new. Like, we've been working at this for 25, you and I for 25 plus years. I mean, it's,
it's very disconcerting, but we're customer centric. It says so in the break room poster.
It's right there. 4 to 6 days will be customer centric. All right. Well, let's bring this part of the episode home. Let's bring this episode home. So let's talk about really what it's going to take to bring this together. Because, arguing about these things, cannibalization and how you measure, it's kind of like a little bit about, let's have a big debate about gravity. So how do you bring this home for us, and how do we think about this and leave the listeners with some advice? Maybe they're struggling with the same things internally.
Well, a few things. I think, to this topic we just talked about, I mean, it's thinking about, getting away from the channel-centric thinking about it from a brand perspective, and then organizing yourself in such a way that you create this harmonious experience and that you don't put your store channel in competition with the online channel. So that's definitely one. I think the other thing, which is really important, is to start, and we talked a little bit about this in an episode, I guess, last year, about understanding that stores, brick and mortar, are no longer just places for customers to go, see what you have, pick it up, and pay for it. That they perform a much more hybrid or diverse role. And I've talked to a lot of retailers about some of these challenges. This was a topic of conversation in my panel in Shop Talk Europe, because, suddenly you've got associates that aren't just waiting on customers. They are, picking, packing, and shipping items from the store, or they're helping
taking
with
returns from online, whatever.
All these kinds of things. So there's a whole operational piece of it, which has got potentially big implications in terms of space allocation and technology and processes and, compensation and all those kinds of things. But I also think we have to think more holistically about the store portfolio strategy for a given market. There's still, I think, too many, and we're seeing a little bit of change in this, but we're still seeing a lot of kind of one-size-fits-all strategies in terms of store deployment. And I'll use an example I think we talked about a few weeks ago about IKEA, and I saw this when I was over in Europe as well, with IKEA with these huge stores, which are destinations, but now starting to open these design studios. So asking yourself, the customer, what is the store for? Is a location for the customer to go there and see kind of everything you have and take it home with them? Is it there for them to go design a project and the product gets shipped to them later? Is it there for more service functions or some combination? So I think of a lot of retailers that are just kind of continuing to do this one-size-fits-all approach and optimize it, in fact, need to get much more aggressive about reconfiguring the individual formats, perhaps for different roles. And, that might mean a different location. That might mean a smaller size or a larger size. It may mean, all sorts of different technology like micro-fulfillment that we've seen Walmart and Target and others adding. So I think there's a lot of potential change, and understanding really what physical retail is meant to do is more complicated today, and you should reflect that in your strategy.
Well, great episode. Enjoy these episodes. I think our listeners do too, because it gets us the chance to kind of riff or jam, as our friend Carl Boutet would say. So let's leave it there, because I'm sure it's not the last time we'll talk about this, and hopefully we added some insight and you added some perspective for the listeners. So we'll leave it there. If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Judith McKenna, President, International, Walmart. New episodes of Season 6, presented by our friends at Market Dial, will show up each and every Tuesday. And be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn. You can catch up with me on the stage at Store Conference in Toronto, May 31st. And you can see both of us at the Lead Innovation Summit in July, live on stage in New York with our friend of the pod, Simeon Siegel from BMO. Until then, safe travels, everyone.